Welcome to More Than Commas, where we help you navigate the world of finance beyond the numbers. I'm Paul Adams, and today we're diving in to one of the most common questions in personal finance. What's the difference between a Roth IRA and a traditional IRA? If you're planning for retirement, understanding these two can make a huge difference in how you build wealth. But before we jump in, make sure to hit that subscribe button and leave us a review, make a comment. It helps more listeners find the show. Now let's dive into today's topic, the difference between a Roth IRA and traditional IRA. These are two of the most common retirement accounts, but they operate very differently, especially when it comes to taxes, contribution limits, and withdrawal rules. First, let's tackle the primary difference, taxes. With traditional IRA, the contributions you make are tax deductible, meaning you reduce your taxable income for the current year. For example, if you contribute $6,000 to a traditional IRA and you're in the 24% tax bracket, you reduce this year's taxes by $1,440. The catch? When you withdraw that money in retirement, every dollar is taxed as ordinary income. That means if you're in a higher tax bracket when you retire, you could face a significant tax burden. Now, on the flip side, a Roth IRA works the opposite way. You don't get any tax breaks today on your contributions because they're made with after-tax dollars. However, the key advantage of a Roth is that when you retire, every dollar you withdraw is tax-free. That includes any earnings or growth from your investments inside the Roth. This can be a massive benefit if you expect to be in a higher tax bracket in retirement, or if you anticipate that tax rates might rise in the future. Stick around because you'll want to hear the rest of the difference after this word from our sponsor.
This episode is brought to you by Sound Financial Group. At Sound Financial, we specialize in helping clients build strong, long-term financial strategies for their retirement. If you're looking for personalized advice to help manage your wealth, visit us at sfgway.com to learn more about how we can help you achieve your goals.
Taxes aren't the only difference. Another factor to consider is contribution limits and eligibility. For both traditional and Roth IRAs, the contribution limit in 2024 is $6,500 for those under 50 and $7,500 if you're 50 or older. However, there's a catch when it comes to the Roth IRA. Income limits, if your income is above a certain threshold, in this case $153,000 for single filers, or $228,000 in 2024 for married couples filing jointly. You're not eligible to contribute to a Roth IRA if you make over those limits. But don't worry, there's a workaround called a backdoor Roth IRA. This strategy allows you to contribute to a traditional IRA, then convert those funds into a Roth IRA, bypassing the income limits. I won't leave you hanging on how to do a backdoor Roth. We're just going to have to show you this in our next episode. With traditional IRAs, on the other hand, there are no income restrictions to contribute, but your ability to deduct contributions depends on your income and whether you or your spouse have access to a retirement plan at work. If your income is too high and you have a 401k or similar plan, your deduction might be limited or phased out completely. Another key difference between the two accounts is the required minimum distributions, also known as RMDs. With a traditional IRA, once you hit age 73, the government requires you start taking money out a certain percentage each year. These distributions are subject to income tax, and if you fail to take them, there's a hefty penalty up to 25% of the amount you were supposed to withdraw, and yet they still tax it. Roth IRAs, however, don't have RMDs. You can leave your money in the account for as long as you live. So here's a question for you. Are you expecting to be in a higher tax bracket in the future, or are you more focused on getting that immediate tax relief? If you think taxes will go up or your income will be higher in retirement, a Roth IRA might be the better choice. However, you expect to have a lower taxable income later in life or want to reduce your taxes now, a traditional IRA could make more sense. Now, it's also worth considering flexibility in retirement. If you want more control over how and when you have access to your money, the Roth IRA really stands out. Since Roth contributions have already been taxed, you can withdraw your contributions at any time without penalties. This can give you a lot more freedom if unexpected expenses come up, or if you want to retire early and need access to funds before that traditional age 59 and a half. Traditional IRAs don't offer the same flexibility. While there are some exceptions, you'll generally pay a 10% penalty if you withdraw funds before age 59 and a half, in addition to your regular income tax on those withdrawals. One last thing to think about is your estate planning. If you're planning to leave a legacy for your heirs, a Roth IRA offers significant advantages. Since Roth IRAs don't have RMDs, you can let your account grow tax-free for as long as you live. And when you pass, it goes on to your heirs. They can continue to benefit from tax-free growth for a period of time, depending on the current inheritance and tax rules. Traditional IRAs, however, can pass on a tax burden to your heirs because those withdrawals will still be taxed at their ordinary income. So which one's right for you, Roth or traditional IRA? It really depends on your current financial situation and your long-term goals. We'd love to hear your thoughts. Do you have a preference between the two? Let us know in the comments down below. Or connect with us on social media. And if you found this episode helpful, be sure to like, share, and subscribe, and you'll get more content just like this. Thanks for joining us today on More Than Commas. Next week, we'll be talking about how high-income households can still do Roth by using the backdoor Roth strategy. So stay tuned for that. And as always, visit sfgway.com for more resources and information. That's it for this episode. Now go back to building a great life.